Kevin is sitting in a padded chair on the 14th floor of a downtown Toronto office tower. Nice view. There's a little branded coaster under his coffee cup. The guy across the desk is wearing a lanyard and a good blazer, and he's been very friendly the whole time, and he just slid a single sheet of paper across the desk with a number on it. Kevin's RRSP has grown by $14,000 over the last 3 years. Kevin thinks that's pretty good. Kevin says, "Thank you, this is great." Kevin signs the form. Kevin goes back to work. Kevin has no idea he just lost $200,000, not in a crash, not in a scam, not by doing anything wrong, just by sitting in that chair, in that nice office, next to that coaster, paying a fee he can't see, in a fund he didn't choose, managed by a person who is not legally required to care whether Kevin retires with dignity or not. The fee is 2.2%. It says so on the fund fact sheet in an 8-point font at the bottom. Kevin didn't read the fund fact sheet. Most Canadians don't. My name is Nick, not a financial advisor, just math. Hit subscribe. Let's go. Here's the number I want you to hold in your head for the next 20 minutes. $431,000. Not what Kevin lost in a crash, not what he'll owe in taxes. What he will quietly, invisibly, structurally fail to accumulate over 30 years. If he stays in a standard Canadian bank mutual fund instead of a low-cost index ETF. Same market, same contributions, same timeline, same person. The only difference is a fee of roughly 2% per year. 2%. Sounds like nothing. It is not nothing. It is the single largest wealth transfer mechanism in Canadian personal finance. And the reason you probably don't know about it is because the people charging it have spent 50 years building an industry designed to make it feel completely normal. Before we do the math, I need to explain exactly how the fee works, because most people have never actually seen the mechanics. In Canada, the mutual fund industry charges what's called a management expense ratio, MER. It's an annual fee expressed as a percentage of your total assets in the fund charged every single year you hold it. The average MER for a Canadian actively managed equity mutual fund runs somewhere around 2.0 to 2.5% per year. For some balanced funds, it's closer to 2.3%. For some equity funds sold through advisors with embedded trailer commissions, you can hit 2.7%. Now here's the part that trips people up. The fee is not a line item on your statement. It is not deducted in a separate column at year end. It is not a bill you receive. It is quietly, continuously skimmed off the top of your fund's returns before your statement is ever generated. The number your account shows you is already after the fee was removed. You are never shown what the number would have been without it, which means Kevin has no idea he's paying it. He just sees his balance going up most years, assumes he's doing fine, and takes the coaster coffee. Compare that to VEQT, Vanguard's all-equity ETF, globally diversified across thousands of companies in dozens of countries. MER, 0.24%. XEQT from iShares, 0.20%. ZEQT from BMO, 0.20%. You can buy any of these in a Wealthsimple or Questrade self-directed RRSP in about 45 minutes. 2-point-something% versus 0.2%. The gap is roughly 1.75 to 2 percentage points, and over 30 years, that gap doesn't add up. It compounds up. Let's do Kevin's math. Kevin is 38. He has $80,000 in his bank RRSP. He contributes $500 a month. He plans to retire at 68. That's 30 years. The market broadly returns around 8 to 9% per year over the long run. Let's use 8% as our baseline. Historically on the conservative side for a globally diversified equity portfolio. In Kevin's bank mutual fund at 2.2% MER, his actual net return is about 5.8%. After 30 years, with his monthly contributions, approximately $619,000. In a self-directed Wealthsimple RRSP holding VEQT at 0.24% MER, his net return is about 7.76%. After 30 years, approximately $1,050,000. The difference, $431,000. Kevin doesn't lose $431,000 in a crash. He never sees it. It was never credited to his account. It was quietly, legally, structurally removed, 1 point something percent at a time, every single year, compounding against him, growing as his portfolio grew. Think about what that number actually means. At Kevin's retirement, $431,000 at a safe withdrawal rate of 4% generates about $17,000 a year in additional income. Every year. Forever. That's the vacation he never took. That's the help for his kids. That's the difference between retiring at 68, feeling comfortable, and retiring at 68, running spreadsheets about whether he can afford to replace his furnace. That's not a bad month in the market. That's the quiet destruction of a second retirement fund. Now, most financial videos stop there. Fee bad, ETF good. Bye. We're not going to stop there. Because there's something more interesting going on, and it explains why Kevin and millions of other intelligent, financially aware Canadians are still sitting in those mutual funds right now. The fee is not the villain. The fee is just a fee. The villain is what the fee is telling you you're getting for it. When a bank employee hands Kevin a fund with a 2.2% MER and says, "This is professionally managed by a team of expert portfolio managers," the implicit promise is, you're paying for expertise. You're paying for someone smarter than you to navigate the market. You're paying for active management that will outperform the plain index. That's the deal. So the real question isn't just, what does the fee cost me? The real question is, what am I getting for it? And here's the answer, and I want you to really hear this one. Over the last 15 years, according to S&P's SPIVA Canada scorecard, and this is published data, not opinion, approximately 93 to 95% of Canadian active equity funds have underperformed their benchmark index over a 15-year period, after fees. Let me restate that in plain English. Roughly 19 out of 20 Canadian mutual funds, run by professional analysts with Bloomberg terminals and trading desks and quarterly strategy sessions, they do worse than just buying the whole index and sitting on it. After you subtract the fee you paid them to try, and it's not just a few percentage points worse. In many cases, the long-term underperformance is substantial. The fee alone explains most of it. You would have done better with no manager, no analysis, and a 0.25% ETF. You are paying a premium for something that has a greater than 90% chance of losing to the thing that costs almost nothing. Kevin is not being ripped off by someone who tried hard and got unlucky. Kevin is enrolled in a system designed to capture his assets and generate fee revenue wrapped in the warm, padded comfort of professional management and a branded coaster. The industry is not failing. It is working exactly as designed, just not for Kevin. That's the hidden villain. Not incompetence, institutional design. Let me explain something about your bank advisor, because this is the part that nobody says out loud. The person sitting across from Kevin at the bank is almost certainly not a licensed financial planner. They may have taken a series of mutual fund licensing exams. They may have a title that includes the word advisor. But in most bank branch settings, their primary job is to retain and grow the bank's assets under management. Their compensation is tied to sales targets. The bank mutual funds they are recommending are, in many cases, the bank's own proprietary products, the same ones that charge the highest MER. This is not an accusation, it's structural. The bank's branch advisor is not your friend and not your enemy. They are an employee of a large financial institution doing their job within a compensation system that rewards keeping money in high MER products. Most of them believe they're helping. Most of them have their own RRSP at the same bank and the same kind of fund. The problem is the system, not the person. Up until 2022, there was something called a trailing commission, a trailer fee, built into most Canadian mutual funds sold through advisors. A portion of the MER went directly to the advisor's firm every year you stayed in the fund. So the advisor's brokerage was financially incentivized to keep you in the fund indefinitely, regardless of how it performed. Canadian regulators eventually moved to restrict many of these embedded commissions. But the high MER funds themselves remain. The structure that created them is still in place. And the bank-branch advisor relationship still exists inside a system built to generate fee revenue, not to optimize your retirement. The person in the blazer didn't design that system. They're working within it. And Kevin, sitting across the desk with his coaster coffee, never had a reason to ask whether the system was designed for him. Now he does. Let me bring in two Canadians and show you how this plays out over real lives. Kevin is 38. He grew up watching his parents do their banking at RBC. When he got his first job out of school and his HR person said, "You should start an RRSP," he called his bank. The bank transferred him to an advisor. The advisor was friendly and professional and looked like someone who knew what they were doing. Kevin had no reason to question anything. He signed up for the balanced mutual fund. He set up a pre-authorized contribution. He hasn't looked at the fund fact sheet since. Kevin is not stupid. Kevin is an accountant. He earns $92,000 a year, drives a 2019 Mazda, has 2 kids, and makes careful, considered decisions at work every day. He just never had a reason to question the fee on a fund he doesn't understand, sold to him by a person who seemed like they knew what they were doing inside an institution he's trusted since he was 8 years old, opening his first bank account with birthday money. That's the Kevin problem, and the Kevin problem is the most common investment problem in Canada. Now let me introduce Sandra. Sandra is also 38. She grew up in Hamilton, makes about $85,000 a year as a nurse, and 3 years ago she opened a self-directed RRSP at Wealthsimple and put it all into XEQT. Her MER is 0.20%. Her portfolio looks identical to the broad global market because it is the broad global market. She set it up in 45 minutes on a Sunday. She has not touched it since, except to add money. Sandra is not smarter than Kevin. She is not more financially sophisticated. She does not read investing blogs. She does not watch market news. She just saw the two numbers, her bank fund's MER and XEQT's MER, put them side by side, and thought, why would I pay 10 times more for something that research says will probably do worse? That was the entire decision. That was the 30-minute Saturday morning that put Sandra on a trajectory to retire with $400,000 more than Kevin. They work in the same city. They make similar money. They both think they're investing for retirement. Only one of them is going to find out the gap was there the whole time. I want to handle the objections, because I know what some of you are thinking. Objection 1. My advisor helps me stay invested during market crashes. That's worth the fee. This one has real merit. Behavioral coaching, talking a client out of panic selling in March 2020, keeping them in the market through 2022's rate hike carnage, is genuinely valuable. Research suggests that emotional investing mistakes cost average investors 2 to 3% per year. If your advisor is legitimately preventing you from panic selling, that guidance might actually offset the fee. But here's the problem. The person sitting across the desk at a bank branch is not primarily a behavioral coach. They are primarily a product salesperson. Their compensation is largely tied to selling and retaining bank products. Under current Canadian securities regulations, many of these advisors are not held to a fiduciary standard, meaning they are not legally required to put your interest above their employers. They're required to sell you something suitable, which is a much lower bar than best for you. And the behavioral coaching that's actually valuable, a fee-only financial planner, someone you pay directly by the hour or by annual retainer, can do that too. And your assets can still sit in a 0.20% ETF the whole time. Objection 2. I don't know how to pick stocks. That's why I need a professional. Neither do I. Neither does Sandra. Neither should you. That's the point. The ETF strategy works precisely because it does not involve picking stocks. You buy VEQT. You own thousands of companies across dozens of countries. When the market goes up, you go up. When a few companies stumble, the others carry them. You are not betting on any individual story. You're betting on the global economy continuing to function, which, over any 30-year window in recorded history, it has. The mutual fund doesn't solve the stock-picking problem for you. It hands it to someone else and bills you for the privilege. The ETF says, no one can reliably pick stocks over the long run, so we're not going to try, and we're certainly not going to charge you 2% per year as if we can. Objection 3. Wealth Simple is relatively new. My bank has been around forever. What if something happens? Wealth Simple holds client assets separately from its own operating capital. It's a member of the Canadian Investor Protection Fund, CIPF, which covers eligible investment accounts up to $1 million per account category. Questrade has been regulated since 1999. The shares of VEQT you hold in a self-directed RRSP are your property, held in your name in a registered account. If the broker failed tomorrow, those assets would be transferred to another institution. The institutional risk here is not meaningfully different from the bank down the street, and in some structural ways, it's better defined. Here's the caveat I want to give you before we close, because I mean it. Paying for financial advice is not the problem. Planning is real. If you have a complex situation, a defined benefit pension decision, a business sale, a complex estate, a tax situation that spans multiple provinces or involves foreign assets, a good fee-only financial planner is absolutely worth the money. In Canada, you can find them through the fee-only network or by searching for planners who are compensated exclusively by their clients. You pay them directly. You know the number before the meeting starts. You can compare it to other planners and decide whether it's worth it to you. The distinction is fee-only. You pay them directly, you know the number, you can verify it and compare it. They have no incentive to put you in a product with an embedded commission because they're not earning one. They might still recommend index ETFs. Most of them do, but now you're paying for the planning work itself, the tax optimization, the drawdown strategy, the estate structure, not for someone to manage your money into an underperforming fund while calling it advice. The bank mutual fund with a 2.2% MER is not fee-only. You never receive a bill, you never see a deduction, you never have a chance to decide whether the value is worth it. The fee is already built into the product, charged continuously, compounding in reverse on your behalf every year you hold it, regardless of whether you get advice that year, regardless of whether the market was up or down, regardless of whether you called and talked to anyone at all. If you want advice, buy advice. Don't pay for it silently in MER. Let me show you the number one more time before we close. You're 35. You have $50,000 in your RRSP. You contribute $400 a month. 30 years until retirement at 65. At 8% gross market return in a 2.2% MER mutual fund. Net return approximately 5.8%. Retirement, RRSP balance, approximately $560,000. Same market, same contributions, same person, in a 0.24% MER ETF. Net return approximately 7.76%. Retirement RRSP balance, approximately $940,000. Difference, approximately $380,000. That money didn't go to market risk, it didn't go to taxes, it went to fund management fees for a product that, historically speaking, had a 19 in 20 chance of underperforming the thing that costs almost nothing. I want you to do one thing after this video. Open your bank account, find your RRSP, and find your mutual fund. There should be a fund fact sheet or a fund details page. Find the line that says MER, or management expense ratio. Write it down. Then search VEQT MER and write that next to it. The gap between those two numbers, compounded over however many years you have left until retirement, is the number this entire video was about. You don't have to do anything else today. You don't have to fire your bank. You don't have to open new accounts tonight. You don't have to become someone who reads quarterly fund reports. If you want to make the switch, the process is open a Wealth Simple or Questrade self-directed RRSP, fill out an RRSP transfer form, hold VEQT or XEQT, set up automatic monthly contributions, and do not log in for another 6 months. That's it. That's the whole strategy. Kevin is still in that chair. He is a smart, responsible Canadian who has spent 10 years doing the right thing, saving, contributing, not panic selling, while a structural fee quietly redirected a significant portion of his wealth somewhere other than his retirement. He is not a cautionary tale. He is the average. He is most Canadians. Sandra is on the 403 heading back to Hamilton in her 2017 Civic with the Tim Hortons. She did not spill on herself. XEQT bought itself automatically 3 days ago. She hasn't logged into Wealth Simple. She is not thinking about her portfolio. She is not watching market news. She is not meeting with anyone in a good blazer on a 14th floor. She is going to retire with hundreds of thousands of dollars more than people who were trying harder than she was. Because she saw the fee, she did the math, and she got bored on purpose. The boring investor wins again. My name is Nick, not a financial advisor, just math. If this video helped, hit subscribe. There are a lot of numbers like this one that the industry would prefer you never ran, and we're going to run all of them.